MACD stands for Moving Average Convergence Divergence. Developed by Gerald Apple, this is an indicator for recognizing trends and momentum. It consists of two lines, the MACD line and the signal line. Now this MACD is the difference between a 12 periods and 26 periods exponential moving average. A 9 periods exponential moving average of this difference, called the trigger or signal line, is used to generate signals. Now this MACD line is usually displayed as a solid line or histogram, and the signal line is usually displayed as a dotted line. Now this MACD depicts the vertical distance between two exponential moving averages curves, which is like 12 and 26 period settings, and the zero line or center line is a point where two moving averages would intersect. When the MACD line crosses over a center line, it signals a crossing in the moving averages. Now the most widely used settings for MACD is 12, 26 and 9, and the other being 8, 17, 9. So here is the trading strategy. Now the elementary strategy is to buy when MACD crosses above the trigger line or zero line, and sell when MACD crosses below the trigger line or zero line. Also look for divergence between price data and MACD for buy or sell signals. Let's understand the MACD cross, the elementary trading strategy, and we will deal with divergences some point in time later. Now this elementary strategy is quite simple. Here the red line is MACD and the dotted one is a trigger line. You buy when MACD crosses this trigger line from below. Blue arrows are the buys. So we have a signal here, 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 and all such places. And you would sell when MACD crosses the signal line from above. So accordingly, we are going to sell here, 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 and all the red arrows in place. So let's interpret the same on a chart now. We have entire buy and sell signals on this chart. So if we consider all the setups, then we have a profitable setup here, then a loss-making one, a small profitable setup over here, then again a loss-making one, then a good profitable trade here again, and then this one is a loss-making one, this one is again a loss-making one, this one goes for a loss, and this one turns out to be profitable, and so forth. So what we just discussed is purely an elementary strategy. No doubt following this strategy will result in some profits over longer run, minuscule profit however, and that too if you are trading with sheer discipline. Now let's do something different and significant. What we are going to do is very logical and obvious, but amateurs, not surprisingly, do not tend to do that. Let's see what happens if we juxtapose this elementary strategy with concept of trend that we discussed earlier, and how things change drastically. Recall that the uptrend is in place when we have higher highs and higher lows, and a downtrend is when we have lower lows and lower highs. So this phase over here, we have a series of higher highs and higher lows defining an uptrend. And this phase here is a clear downtrend with lower lows and lower highs in place. Now the idea is to only take buy signals when the trend is up and sell signals when the trend is down. Now this small technique will remarkably filter out most of the bad signals. Now this being an uptrend, we must not take this sell signal and this one here. We save ourselves from these two loss-making trades, and we have 3 profitable trades. And here in this phase, where the market is trending down, we do not consider any buys. So we sell here, here, and here. We have all profitable sell trades. See how the success ratio changes. Earlier we were having 6 profitable trades and 5 loss-making trades. And now we have all 6 profitable trades. Now, having 6 out of 6 profitable trades do not mean that we have a holy grail now. This chart is just very fortunate. So this piece of logic must be applied to all trend following indicators and also some oscillators like stochastic.